Good afternoon from Singapore, ladies and gentlemen, and welcome to the second IBOR Transition virtual client webinar. This is being hosted by Standard Chartered Bank and is our second one for this month. Today, we are focusing on what the recent announcements have been from regulators and what these mean for the IBOR transition timeline. Also, how it may impact remediation of your existing LIBOR-linked contracts, and how we at Standard Chartered are preparing to support our clients for this transition. Before proceeding, we wish to point out that today's presentation and supporting materials have been prepared by Standard Chartered for the purposes of this client briefing only. As you would appreciate, LIBOR transition is a constantly evolving topic, and some of the information in this briefing may be subject to change after this date. The presentation and its supporting materials are not intended in any manner and should not be represented or interpreted as Standard Chartered providing advice. We recommend that you continue to obtain your own independent professional advice in this regard. The next slide, please, Joe. So my name is Carmini Rambazek, and I am from the Standard Chartered Central IBOR Transition Program team. Joining me on the call today is Ryan Goh from our rates trading team, as well as Tek Piao from our compliance team. A few housekeeping points before we move forward. We are using Blue Jeans Events to run this briefing session, and we will be sharing slides on the screen, as hopefully you can see it now, and all attendees have been placed on mute. If you are having trouble viewing the slides, please expand the screen or move the slider bar, both of which are found at the bottom of your screen. And note that this is a client-facing session. Throughout the presentation, you may post your questions in the Q&A panel on the right of your screen. You'll see the little Q&A icon there, and our panelists will pick up your questions and address them at the end, or even some of it through the course of the presentation. If we do not get to your question, please be assured that we will follow up with you afterwards. So please do sign in with your full name and details, and over the next few days, we will also be sending you a link to the website where you can access these slides, as well as a recording of today's session. So look out for the follow-up email to come in the coming days. Thanks, Joe. The next slide. So what do we expect to, or what can you expect to get out of this session? As I mentioned, we'll walk through the latest news of cessation timelines for the different LIBOR rates and the response from the markets to these announcements. We'll also speak about the development of RFRs and, of course, our bank's capabilities. And we'll talk you through the latest stance on term rates, a question we receive quite often from our clients. You can also expect to hear more about our remediation approach and the options clients may have to manage their legacy or existing LIBOR-linked contracts. And finally, we'll give you an idea of our plans to engage with you as we move towards these different cessation dates. On to the next slide. Thanks, Joe. So with respect to the announcement on cessation dates, just last month, on the 5th of March of 2021, the UK FCA, the regulator, announced the timing for the cessation or the loss of representativeness of all 35 LIBOR settings. And why was this important for markets? Well, the IBA announcement provides market participants with the confirmation of the cessation of LIBOR and also clarity on the timeline for the cessation of each of the 35 LIBOR settings. And this is aimed at accelerating the transition efforts across the market, as we've heard quite often from market participants, consistently citing that a lack of firm deadlines has been a barrier to the transition. We've have heard from other organizations as well. So for example, ISDA, or the International Swap Dealer Association, their CEO, Scott O'Malley, commented that the IBA announcement will likely put a rocket on transition events or transition efforts, and it allows firms to push forward with their transition initiatives now that these deadlines and spread adjustments for the fallback rates are fixed. And we'll speak a little bit more about these in the subsequent slides. So on the back of the IBA and FCA announcing, sorry, Joe, the next slide. On the back of this, other regulators and various working groups have also set target dates for the cessation, particularly for the issuance of new LIBOR-linked derivatives and cash products in 2021. In the US, for example, the Alternative Reference Rates Committee, or the ARC, has recommended also in March of this year that dealers change the market convention for quoting US dollar-based derivatives from LIBOR to SOFR. And the ARC has also recommended that no new LIBOR derivatives maturing after 2021 are initiated after June of this year, unless those trades are intended for risk or default management of legacy LIBOR positions. We have subsequently heard from the US Fed agencies as well, saying that with the IBA announcement pushing out our US dollar dates, that the cessation of new US dollar LIBOR issuances could push out as well to the end of December. We have not heard the ARC reiterate that yet, but it is quite anticipated that that announcement will come as well. Moving on to the next slide, thanks, Joe. So this slide gives you a summary of all the dates and the 5 LIBOR currencies. I won't read them out. You can read them here. And as I said, we'll share the deck with you. So in summary, the 31st of December cessation date applies to all 7 euro and Swiss franc LIBOR tenors. It also applies to some sterling LIBOR tenors and some Japanese yen LIBOR tenors. Furthermore, the 1 week and 2 month US dollar LIBOR is also going to cease at the end of this year. So publication of the overnight and 12-month US dollar LIBOR settings, these two have they've moved actually to the 30th of June of 2023. Now, when this announcement was made by the IBA and the FCA, it also announced that it intends to consult on whether the ICE benchmark should publish 1 month, 3 month, and 6 month settings on a synthetic basis. And it applies to, as you can see here, it applies to the GBP LIBOR, Japanese yen LIBOR, and the certain currency, certain tenors of the US dollar LIBOR, so 1, 3, and 6. And what this means is they clarified here that the publication of synthetic LIBOR is very much intended to protect consumers and market integrity. And what it's intended to do is to reduce disruption in the markets where it's unlikely to be feasible to convert a certain outstanding contract that references LIBOR to an alternative reference rate. We've also heard from other organizations to say that, such as the FSA and the Bank of Japan, saying that this should be considered as a potential safety net and used only for legacy contracts that are difficult, or it's not feasible to transition them through active conversion or the insertion of a fallback language. But we are expecting more information on this in the coming months. For now, the cessation dates are broadly the end of December for most non-US dollar, and for US dollar, most tenors, it is for 30th of June 2023. So moving on to the next slide. Thank you, Joe. So there are 2 eyeballs worth mentioning here as well, given the audience we have today. We do receive a lot of client queries on these as well, and this is for the cessation timelines for SAW and Thai baht fixed. So the Singapore's regulator here has made some announcements too. Both of these eyeballs have a US dollar LIBOR component in their calculations. Hence, the cessation dates on US dollar are aligned, and both regulators, both here in Singapore, the ABS, and in Thailand, the Bank of Thailand, they've announced and confirmed that the cessation dates for both will now be the 30th of June 2023. So there's lots more information here in this pack. As I said, we'll share it with you, and the words confirmed and announced on this slide are hyperlinked to the announcements from these organizations, regulators. With that, I'm now going to pass on to Ryan Goh, who will continue with the presentation, commencing with the key differences between LIBOR and RFR. Ryan?
Thank you, Kamini. So I'd like to take everyone back to the March trigger date, where the authorities essentially declared that LIBOR of 5 currencies, namely Swiss francs, euro, pound sterling, Japanese yen, and the US dollar, will cease to be representative. Now, so this triggered fallbacks with regards to what legacy LIBOR-based contracts will convert to in a world of risk-free rates, also known as RFR. Now, as a brief recap with regards to how this fallback will be like, post the so-called index cessation effective date, in other words, the date where LIBOR will no longer be published, every instance of LIBOR will be replaced by the risk-free rate compounded over the same IBOR tenor plus the credit adjustment spread. And this is also known as a CAS. Now, these spreads have been locked in on the 5th March index cessation event, post the announcement by the FCA and the IBA, and it is shown in the table in the slide. Now, as an example of how to read this, in the case of US dollar 3-month LIBOR, it will fall back to compounded SOFR, which is the chosen RFR to replace dollar LIBOR over 3 months because it's the same IBOR tenor, plus a CAS of 26.161 basis points. So this is how to read this table down here, and it's available actually online via Bloomberg as well. Can we move on to the next slide, please? So as I've described in the previous slide, IBORs and risk-free rates are fundamentally different in 2 key respects. Now, firstly, IBORs are generally forward-looking term rates, whereas risk-free rates are backward-looking and often overnight rates. So this leads to a term premium being embedded in LIBOR, but not the risk-free rate. Secondly, the bank credit premium is also embedded in IBORs, but not the risk-free rates, which tends to be risk-free or in some cases near risk-free. So as such, in order to establish equivalence between the IBOR and RFR, we will have to add the credit adjustment spread, also known as CAS, and the numbers and methodologies are both described in the previous slide in a sense that we'll have a 5-year median look-back approach for this. Standard Chartered has also been actively involved with regards to providing feedback and comments to the various working groups on IBOR transition. And indeed, much work has been done to obtain an industry standard with regards to the methodology used to obtain a fair replacement for the various LIBORs. So we envisage that this will remain a key focus of many clients, especially to ensure consistency between IBOR-based cash as well as derivative products. And thus, it's important to get an assessment with regards to how they'll behave under the scenarios of contract fallbacks as well as active conversion. Joe, can we move on to the next slide? So in this slide, we will explain how the basis markets reacted the way they did on the announcement date. And this is largely a function of the methodology that was used to determine the credit adjustment spread. As a brief recap of this methodology, so ISDA, prior to the indexation event, they held many industry consultations, and market participants kind of agreed on this 5-year historical median approach in determining the CAS. And what this means is that on that day itself, on 5th March itself, they'll look back over a period of 5 years. And on each day, you compute the relevant spread between LIBOR and the risk-free rate. So altogether, we have 5 years worth of data, and we'll take the median of the data as the CAS. Now, the chart on the right illustrates the term structure of the US dollar tenor basis swaps. So in other words, US dollar LIBOR 6 months on one leg versus US dollar 3 months LIBOR plus the basis on the other. So taken in totality, this represents snapshots of the term structure at the beginning of the year, as well as on 5th March 2021, which was the announcement date that crystallized the spread adjustment. Broadly speaking, the basis at the beginning of the year is higher across most tenors as compared to that of the post-announcement of 5th March 2021. So this is because markets are pricing in a Q2 or Q3 discontinuation timeline for the indexation event that crystallizes the CAS. An analysis using both the historical fixing and the implied forwards reveals that as these events get pushed further back in the year, the CAS tends to be smaller. So as such, when the IBA made the announcement on 5th of March, it was a little bit earlier than what the markets were pricing in, and therefore this led to a wider credit adjustment spread and as well as a slightly wider tenor basis. So as a result, this explains why the term structure of the tenor basis swaps post-announcement, which is depicted by the green line, is higher compared to the beginning of the year. Can we move on to the next slide, please? Thank you. So the markets have been quick to reprice following the IBA announcement, and this is evidence with regards to how the implied forwards in the SOFR LIBOR basis have effectively converged to the fallback spread adjustment. So the chart on the right shows how the 3-month dollar LIBOR versus compounded SOFR over 3-month basis looks like in the forward space. And to be precise, it's 5 years forward. So we can see how they are within a narrow range of the theoretical 26.161 basis points, which, as we recall, is a credit adjustment spread for US dollar 3 months LIBOR. So I'd like to conclude my portion by making an important remark. It is imperative to note that these fallback spread adjustments will be effective at the beginning of next year for the G4 IBORs, so namely Swiss, Euro, Sterling, and Yen, and on 1st July 2023 in the case for dollar LIBOR. So the IBOR versus the risk-free rate basis between now and those effective dates tend to be much smaller. And this is largely a function of extraordinary monetary policies enacted by global central banks in response to the economic challenges posed by the outbreak of COVID-19, and therefore, resulted in smaller funding spreads. So that's it for my portion. I will now hand it over to Tiao Piao, who will take you through the rest of the deck with regards to the various IBOR and risk-free rate milestones. Tiao Piao?
Hey, thanks, Ryan. So a quick recap, as Kamini and Ryan mentioned, the FCA, since the FCA announcement of 2017, about no longer compelling banks to contribute to LIBOR, there has been various industry and public sector working groups in each of the 5 LIBOR jurisdictions working to identify the successor rates. So some of these rates, I think you will be really very familiar with. And these rates have come to be known as the risk-free rate. So we have a table of this in the next slide. Show slide 16, please. So for each of the LIBOR currencies, there are the equivalent risk-free rates. So for dollars, there is SOFR, SOFR. Sterling, there is SONIA, and for yen, there is TONA and SARA for Swiss franc, and ESTER for euros. So we have added one more, which is for Sing dollars. So the current Sing rate is the swap overnight rate. So the risk-free rate that has been identified in Singapore is SORA. So this gives you a quick snapshot of the risk-free rates that have been identified and will replace LIBOR. And some of them have already progressively, I think, taken LIBOR's place in a lot of transactions already. Next slide, please, Joe. So, as I think you'll be aware, LIBOR has a term. It is a term rate, whereas the risk-free rates are generally backward-looking overnight rates. And there has been a fair bit of discussion in the industry and also within the national working groups with the regulators on the possibility of a forward-looking risk-free rate and how such forward-looking risk-free rates could be used. So a quick recap again. Generally, the UK Sterling Risk-Free Rate Working Group has determined that 90% of the sterling market for loans can use compounded in arrears. So this is the methodology that has been used, that's been proposed, and the sense is that a super majority of the market can use compounded in arrears. There may be certain selected areas that might need a forward-looking term rate, term SONIA. And recently, the FICC Market Standard Board has published a draft standard to look at the use of such term rates. And they've identified, I think, certain niche sectors, such as Islamic banking, as well as trade products that require discounting. So the use of the term rate of a term RFR is likely to be very limited, as in the sterling world, the expectation is that most of the transactions can be using SONIA compounded in arrears. So for clients, what you should be looking at is looking at your exposures and looking at what you can do in the compounded in arrears space, and whether you need any systems enhancement, operational enhancements, as well as tax and accounting considerations. Speak to our bankers like us, and then from there we can work through whether there are any I suppose areas which clients can look at in terms of using compounded in arrears type concepts. And generally, the message from the regulators in the UK, as well as industry bodies and regulators in the US for SOFR, is that firms and the industry generally should not wait for term rates. First, the term rates themselves, let's say in the dollar space, might not be forthcoming this year. The industry conventions, the market conventions, the transaction conventions, and the product type that could use such term rates might be limited, and obviously they would have to be developed when the term rates are proposed and ready for use. So the sense is that clients should look at, where possible, to transition away from LIBOR, but not with term rates, into other methodologies like compounding in arrears. Next slide, please, Joe. So this slide gives you a quick snapshot of where different jurisdictions are and on term rates, and you can, from here, you can also sense why I think the regulatory and industry message has been to not wait for term rates. So for US dollars or SOFR, the authority, the ARC, has announced that it will not be in a position to recommend a term SOFR by middle of this year, which was its original timeline, and they can't guarantee that it will be able to do so by the end of this year. So in the UK, there is actually 2 term rates that have been published by the ICE Benchmarks Administration as well as Refinitiv. However, as I've mentioned, the expectation is that the use of such term SONIA is expected to be very limited to those niche areas. And in the other 2 areas, for Japan, TOF, which is the Tokyo term rate, the expectation is that the administrator Quick will publish them on the 26th of April, whereas in Europe, the ECB is still working through with vendors and administrators on a term ESTA. For completeness, in Switzerland, the Swiss working group has decided that Sauron, which is the Swiss risk-free rate, will not have a term structure. So as you can see, for term rates, the first, I think the developments are still fairly nascent, and second, the expectation is that that firms will not be allowed to use the term rates, or the use of term rates will be very limited. So that's the status on term rates and where they are. Next slide, please, Joe. So this slide covers the key transition milestones that we have seen that have been proposed by the national working groups as well as selected regulators. So for I think a few things to note, is quite a busy slide. A few things to note. First is that in the UK or sterling, there has been a milestone for firms to cease offering new sterling LIBOR contracts across loans, bonds, derivatives from 31st of March 2021, so 3 weeks ago. So Standard Chartered, we have adhered to that milestone. So we no longer offer clients sterling LIBOR loans, bonds, and derivatives. For derivatives, there is an exception, which is that if clients are using such derivatives for risk management purposes, that continues to be done. So there are similar milestones in the US, which is the ARC to cease, has a milestone to cease dollar LIBOR sometime this year. And there is also a milestone or a strong regulatory expectation by the US regulators, such as the Fed, for firms to cease new contracts new dollar LIBOR contracts by the end of this year. So we can see that in a way, most of the LIBOR business, new LIBOR business, that the general expectation is that firms will stop offering LIBOR contracts sometime this year, with dollars obviously being the last because of the cessation timelines in 2023. So we've also included a couple of other, I think, milestones here for Singapore. As you can see, as Kamani mentioned just now, so the SCSTS have been working on milestones, and the expectation for firms is that we will stop offering new SOR and SIBOR products from September this year. So similarly for derivatives, there is an exception that firms like us can offer derivatives to clients if these derivatives are used for risk management purposes. So this gives you a quick snapshot of the key developments amongst the national working groups, as well as some of the milestones and and timelines that have been proposed by regulators in this region. Next slide, please, Joe. So the next 3 slides cover reforms in the West, in the East, as well as in other parts of the world. I will not go through this in detail, but I think a message is that as we have seen, the 5 LIBOR currencies are being discontinued. We have also the likes of SOR, but fixed that has been impacted and will be discontinued. There are other relevant benchmarks in a number of countries that has also been impacted, will be reformed or maybe discontinued. So as you can see, if I just pick an example here, for Canada, the Canadian overnight rate is reformed, but then there are the 6-month and 12-month tenors that will be ceasing in about a month's time. So this gives you a sense that, I mean, for clients, I think it's important to have a look at your inventory of exposures, and then from there, work closely with your bankers like us, identify the exposures, and also identify which ones will be affected, whether it's LIBOR or whether it's other IBORs that might be ceasing this year. Next slide, please, Joe. So this slide covers the reforms in the East. So a couple of points to pick up, which is India and Philippines. So India and Philippines, there are 2 benchmarks, one in India and one in the Philippines, that is similar to SOR and Thai baht fix. So they use dollar LIBOR in their computations, and hence when dollar LIBOR ceases, these 2 benchmarks will also be affected. So in India, that benchmark is MY4. In Philippines, it's FIREF. And as with a number of the other Asian countries, like for example Malaysia, India, there's also been reforms. For example, in Malaysia, CLIBOR is there and continues to get published, and there have been discussions about introducing a risk-free rate. So all these discussions are ongoing, and we will encourage all clients to keep an eye on it, especially if you've got exposure to these rates. Next slide, please, Joe. So this covers Africa and Middle East. So there are a number of, like I said, jurisdictions in that region where, again, the local benchmarks are being reformed. So in South Africa, there's a number of benchmarks that might be discontinued or reformed. Similarly, we are seeing developments in a number of these other countries as well. So the general message is the same for clients, which is that if you have benchmarks, if you are using benchmarks, IBOR benchmarks, do keep an eye out. Do talk to your bankers and so that you are updated on whether these benchmarks are changing, will be reformed, or will be discontinued, and then from there plan accordingly on what you should be doing with them. So with that, I think that's a good handover to Kamini, who will talk about the next steps that we are having.
Thank you, Tek Pia. Joe, if we can move to the next slide, please. So as I mentioned at the outset, we are going to talk to you about remediation and what the options are. So with respect to handling your legacy LIBOR reference contracts, it is essential that you have a detailed conversation with your relationship manager at our bank or at your bank. And the reasons for this are that it's really important that you begin to understand the path to remediating LIBOR reference contracts. It's important that you understand or need to know what to do in order to be ready for the remediation, and also what else needs to be considered in that preparation. The timing of such remediation activities is really important, and also any dependencies that may limit or not allow for remediation to take place for whatever reason at this point in time. And remember, when we have a first conversation with you, it will not mean necessarily that at that stage you need to make a decision as to which option to choose. Rather, it's an initial client discussion, and it is in advance of any necessary remediation activities. And it's really the start of what will be an continued dialogue going forward. So what is our approach to remediation? There are 2 options presented here on this slide. So one of the most effective ways to remediate a legacy LIBOR contract is to convert the use of LIBOR in the contract to their RFR equivalent, or the risk-free rate equivalent. So for the use of terminology here, we call it here active contract conversion. And to clarify, it's not mandatory to convert to the RFR equivalent. So for example, if it's US dollar that's being used, it isn't mandatory to convert to SOFR. However, it is recommended given this supports the transition to RFRs. However, it doesn't rule out that there are other possible alternative reference rates that can be used with respect to US dollar LIBOR. Again, discussing these options here with your RM is important, and you have to bear in mind whether that alternative reference rate is suitable for you. You may also speak to your external advisors, such as your lawyers and accountants, etc., before you make that informed decision. So we'll get into the details of active contract conversion on the next slide, but here there are a few key dependencies worth mentioning and considerations as well. And the reason is that it may limit the full extent to which you convert your LIBOR to RFRs, and you just need to be aware of it. So the depth and liquidity of the RFR market will affect the timing and the ease to convert to an RFR. Also, understanding what new RFR products there are and whether they're available in the market. This is important to ensure an effective conversion. You may also want to consider and perhaps ensure that the calculation methodology in regards to compounding in arrears, for example, is suitable, and that your systems and your processes are able to cater for these types of methodologies in RFR products. If active contract conversion is not possible for a valid reason, I'm sure, the next option, or more like serving as a backstop, then is the amendment of the contractual fallback language in your legacy LIBOR contract to something more suitable, to a fallback language that is more suitable. So the reason being here, the existing fallback language in legacy LIBOR contracts likely do not contemplate the permanent cessation of LIBOR, and so a more robust fallback language is necessary to prepare for such a market event. We'll go through details in a couple of slides later as well on this, but it's important here that you understand that amending fallback language does not avoid the need for contract conversion down the track. It should not be relied upon, and hence we should all be focusing on contract conversion, as it is one of the most effective ways to transition away from LIBOR. Thanks, Joe. On to the next slide. So, as I mentioned earlier, it's important to note here that active conversion requires a conversation and a negotiation between the relevant contractual parties. And from our perspective, it will be designed as far as possible to ensure that no detriment is worn on either side of the contract. So key notes here to take away here is that there are two principal changes when it comes to converting a LIBOR contract to their respective RFR equivalent. Because RFRs are overnight rates, the calculation methodology for interest payments and its associated conventions will change, and it will likely be based on the compounded fixing and arrears methodology. It's important that clients understand this, so that's the first one. Secondly, in converting to the compounded RFR equivalent, there'll likely be an adjustment spread applied to reflect two elements that LIBOR had, but RFRs do not. So one is the credit risk component, and two is the term premium, given that LIBOR has a term structure, but compounded RFRs do not. There is an industry-led approach in determining the adjustment spread. There are two approaches emerging from the industry now, and these are the forward approach, which is based on applying the basis between LIBOR and the respective RFR using a forward-looking basis swap, and the historical approach, which is based on using the historical median of the basis between LIBOR and RFR over a 5-year look-back period, and this is what Ryan spoke about in previous slides. So on the historical approach, when the announcement came out on the 5th of March 2021 from the IBA, the credit adjustment spread was published by Bloomberg for all LIBOR tenors, and this was fixed on the 5th of March 2021 as well. And there's more information that you will be able to access in this deck once we share it with you. Moving on to the next slide. So if active contract conversion is not possible, and it is not your preference at this point in time, the alternative remediation option is the amendment of fallback language in your contract. Under derivatives, the industry and Standard Charter 2 have been encouraging our clients to adhere to the ISDA protocol if they have derivatives exposures. It's strongly encouraged as well by regulators, and it will definitely support the transition away from LIBOR. But in some cases, clients are not willing to adhere, or it may not be applicable or relevant. And in this case, amending the fallback language on contracts will require adopting bilateral agreements, which in the case of derivatives have been proposed by ISDA. And what these will do will amend the fallback language in your contracts to be more tailored or specific. Regarding bilateral loans contracts, it is first important to note that the bank continues to align to industry expectations. Last year, as of the 1st of October of last year, all new and refinanced US dollar and GBP LIBOR loans that were offered included clear contractual arrangements. This means that these new products or new contracts would have included in their contractual fallback language any pre-agreed conversion terms or an agreed process for renegotiation. And there are different methods that the industry is currently recommending. The first is the LMA's published draft for pre-agreed conversion, as I mentioned. This uses a switch mechanism and the compounded in arrears methodology. Second is the LMA's guidance on an agreed process for renegotiation using their revised replacement of screen rate clause. And the third is the ARC's recommended hardwired fallback language, which is using a waterfall structure to determine the replacement rate for LIBOR cases. So there are, the difference here is, unlike derivatives, there's no market-wide protocol for the adoption of new fallback language for loans contracts. So it will have to be done bilaterally with the client, and it does depend on the type and the currency of the loan transaction as to which method will be used. It's worth noting here too that these three methods that I've just mentioned, it's been made clear by the industry that it very much depends on the type of contract, the currency, or even your preference as a client. None of them may apply, and there could be variations of it, and all this needs to be considered. Again, all this will depend on your specific circumstances, and you need to discuss with your relationship manager and your external advisors as to which would be best for you. Some clients, we get this question quite often, some clients may want to amend both cash and derivatives contracts at the same time, and if that's the case, it can be arranged. However, given the different approaches and the characteristics between the cash and derivatives market, it's important that you understand any differences such as market conventions used before it's being amended. If clients have hedged facilities, they'd need to address a fallback mechanism for the LIBOR leg of the interest rate swap, which could either be through the use of the ISDA fallback protocol or through the addition of more bespoke fallback mechanisms. Clients should seek external professional advice on hedge effectiveness. There are also further considerations such as matching the conventions between the loan and the hedge, and whether the approach taken does indeed fit in with your broader client transition strategy. So there's lots to consider in there, but definitely one where you would need to take away and speak with your advisors and decide what's best for you before actually remediating those contracts. So moving on to the next slide, thank you, Joe. So as I mentioned earlier, the bank at Tenant Charter, we've developed our RFR capabilities over the last year. We've had several system enhancements, and we've built the in-house capability so that we can offer clients new products priced with these alternative risk-free rates. This table is a summary of the derivatives capabilities, and it's got a bit of detail here which you can read. We will be emailing this to you, as I said, but you can also reach out to your relationship manager for more information on our capabilities. Same with the next slide. Thank you, Joe. This next slide explains our lending and trade capabilities. And the point here is that we do have these capabilities in all active RFR markets. We are ready to support industry standard RFR pricing inquiries as well. And we can provide you with the more granular product capability information if you need it. So do familiarize yourself with this material and the product suite, and speak with your relationship managers for more information on it. Moving on to the next slide. So what can you expect from us? So we will be engaging with you to commence remediation discussions on your LIBOR contracts that are impacted by the cessation date, particularly the 31st of December of this year. So most of you, particularly clients with non-US dollar exposures expiring after 31st of December, you would have received an email communication from Standard Chartered, and your relationship manager may have already contacted you around this to kick off the discussions and to speak about your remediation options. If they've not already done so, you can expect to hear from them in the coming weeks and months. If you are ready to commence your remediation, we will discuss your options and your transition plan. If you're not ready, we will continue our engagement with you on this topic and support you as you make your way through the transition roadmap. And if you have US dollar LIBOR linked products where the benchmark will discontinue after the 30th of June 2023, then the bank will be engaging you at a later time. But however, if you would like to remediate US dollar LIBOR at the same time as your other contracts, other non-US dollar contracts, you can speak with your relationship manager, and that, of course, can be managed as well. Thanks, Joe. On to the next slide. So I guess the key message here is, as your next steps, the point is that the end of 2021 does remain the deadline for the transition of most LIBOR settings. The key focus, of course, is on developing RFR liquidity now, based on the consultation and the announcements from the 5th of March. The timeline for the discontinuation of certain US dollar LIBOR settings has been extended to the end of June 2023. It's imperative for the market to support this transition and drive towards reducing reliance on LIBOR in 2021, particularly for non-US dollar LIBOR. It's important for you to understand what these targets on cessation mean. And of course, today's session is aimed at helping you do that. It's important as well that you familiarize yourself with the markets, the RFR markets, the product, and importantly for you to start, building capability to commence transacting in RFRs. In terms of remediation, as I've mentioned, I've been through all those details there. You would have received, hopefully, a communication from us if you're impacted, but also your RM will be reaching out to you in the coming weeks, engaging with you on this. So with that, we do come to the close of this presentation, and we are receiving questions. So as I mentioned, on the right side of your screen, we do have a Q&A option where you can post your questions. We've had several questions, so I'll make my way through it. And we do have a number of my colleagues here on the line who are SMEs in the field and can pick up your questions as well. So just give me a second. But the first question we do have is from somebody on the fallback rate SOAR. So is the ISDA fallback for SOAR? Is this fallback rate also going to demise soon after the mid-June 2023 demise? Is there any confirmation from the SCSCS or the MAS in Singapore on this? Tek Pia, I believe you're on the line. Do you mind picking up this question on SOAR?
Yeah, sure. So SCSCS has indicated that fallback rate SOAR will stick to the original proposal, which is to cease a year after, so it's in 2024. So it effectively gets published for one more year after SOAR itself gets discontinued by mid-June 2023 together with dollar LIBOR. Kamini?
Yep, thank you. Next question is from Ashutosh around the US dollar LIBOR cessation dates. You've asked, does it mean that borrowers will have an option to borrow either at SOFR or at an applicable LIBOR still available? So Ashutosh, in short, as we mentioned earlier on, the issuance of new US dollar LIBOR products, that will cease at the end of this year, right? So regulators are encouraging us to, by end of December, stop issuing new US dollar. In terms of remediation of existing or legacy US dollar LIBOR contracts, that remediation will really be picked up closer to the date. What we're trying to do now is make, you need to assess whether your contract is expiring after June of 2023, then it will need remediation. In a lot of the cases that it's expiring before June of 2023, so you basically let the US dollar LIBOR contract run out, and any new contract that you sign on will be in SOFR. So I hope that answers your question. We'll move on to another question we had from Ashutosh. I think that I've taken your question here. The next one is, for those with existing floating rate loans, how will the bank address the gap between new benchmark and LIBOR? So for those with existing floating rate loans, how are we addressing the gap between new benchmark and LIBOR? And I think we've got Arpit from our lending work stream. Arpit, you're on here. Do you mind picking this up?
Thanks, Kamini. So, like Kamini mentioned in the earlier slide, for transition of existing LIBOR loans to RFR, the most effective way is to actively convert these contracts. So we have two options, and number one is using the forward-looking LIBOR and RFR spreads, or the other alternative is to use the credit adjustment spreads, which will bridge the gap between the LIBOR and the new RFR rate. So with both these methods, the intention is to keep the existing load largely economically equivalent. So to answer your question, we've got two of these methods to bridge the gap.
Thank you, Arpit. We do have a question from someone saying, how is the how will the mark to market be calculated in the future? Is there any forward rates for the new benchmark? Tech Piao or Ryan, one of you both on here. Can I pass this on to you?
Yeah, sure. So if it's for derivatives, I think Ryan can add on. If it's for derivatives, and let's say if it's trading in SONIA or SOFR, so the mark to market will take place as per what goes on currently for LIBOR, which is we mark to whatever fixings and price that is available in the market. And as we've covered in the slides, right? Right now for SONIA, there are already forward term rates, and for SOFR and some of the other risk-free rates, I think that's still a space that is developing. So right now, not at this point. Ryan?
Yeah, thanks, Tapia. I'm in full agreement with what you have said. I would just add one more point, is that for discounting, though, so for example, for existing derivatives that might see a change in value as a result of discounting, for example, switch from Fed funds to SOFR, then there will be a slight mark-to-market change due to the discounting. But this is just solely based on the interest that is paid on the collateral that is posted. The process that we use to compute mark-to-market is the same, in the IBOR world as with an RFR world. That's the only thing that changes are the curves as well as the discounting.
Thank you, Ryan. We might just move along because there's a few questions here that probably people are interested in as well. What is what's likely to be the LIBOR fallback for cash products on legacy? Give me a second, my questions have disappeared. What is likely the LIBOR fallback for cash products on legacy contracts for SCB clients? This is someone that's posted this anonymously. Lillian, I might ask you to back me up on this, but the short answer is I've given you a quick run through that there are three methods for amending the fallback language in legacy contracts. Obviously, it depends on the rate as well that your contract is written in. But there are three methodologies out there. There isn't a single protocol or approach by the lending market that's being approached because it's quite different to derivatives, and it will involve a bilateral discussion with your RM to make sure that you're actually including the correct fallback language. Lillian, is there anything else that you wanted to mention around fallbacks of cash products? No,
Sorry,
I think
Connie,
Lillian's offline.
did you say for cash products or for derivatives?
Yes, it's for cash products.
Okay, if it's cash products, let's say for loans, for example, depending on the remediation strategy, so if it's active conversion, you probably have to enter into amendment agreements to make the relevant amendments to your, FAs, security documents, related agreements. Whether it's active conversion or fallbacks, the amendments are going to be different, but either way, the contracts will have to be amended.
Yeah, that's right, and it's very much dependent on the specifics of the contract. So definitely something to pick up with your relationship manager, so you can understand further what that means. We did have a question around someone asking, what does the loss of representative actually mean for some of the tenants? So when they do cease at the end of this year, for example, the wording we've had from the FCA and the IBA has been that there'll be a loss of representativeness, and what this means is. Right now, the ICE Benchmark Administration, they are collecting submissions from panel banks, and together they come up with the IBOR rates based on the submissions from these 16 banks. After the end of 31st of December this year, for most of the non-US dollar LIBOR, like I mentioned, they will no longer compel these 16 panel banks to submit. So if there are no banks submitting these rates, there isn't any representative rate to put out there. And that's what loss of representativeness means for these tenants. So it will then start to be, we will then start to use RFRs, which are based on overnight rates and a lot more based on liquidity of the actual markets rather than opinions or judgment from these 16 banks. I don't know if Tech, if you wanted to add anything to it.
That's correct. So basically, what it means is that the rate that the LIBOR rate that's being quoted is no longer representative of the market. So there is a obviously legal and regulatory implication behind it because that affects the spread and things like this.
Thanks, Pierre. Thank you.
And maybe, sorry, Kamini, I could just add to that. So the term non-representative is actually defined in the supplement, the IBOR fallback supplement and the protocol as well. So the added point I would make is that representativeness will not be restored. That's the other criteria.
That's under ISDA. Yep. Thank you so much, Lillian and Tech Piao. We do have a trade question. So how do we manage trade loans which need term rates for discounting LT purposes, so lines of credit purposes? So RFRs with backward-looking concepts could not support such an idea for LT discounting upfront. Arpit, do you mind picking up this on trade loans, please?
Sure, Kamini. So look, there are challenges for the trade industry, and some of the options which are in the lending space, like compounding and arrears, do not work for certain specific trade products. Regulators have also acknowledged this fact. In the sterling space, we do have a term SONIA rate that is available, and it can be adopted to price such discounted products like LC, which has been mentioned. But on the US dollar side, we are yet to see a suitable alternative emerge. We are watching this space and we'll be aligning to markets as and when a suitable rate emerges.
Thank you, Arpit. Another question, and perhaps can I go to the question for Ryan here? How will the fixed cross-currency swap US dollar Singapore dollar transition? How will the fixed cross-currency swap US dollar Singapore dollar transition? Ryan?
Sure, Kamini. So for fixed, because there isn't any, this contract does not involve any reference to LIBOR or any of the IBORs, so nothing would change. The only thing that might implicate the value of this derivative would be the discount curve that is used. So in other words, you need to check what is the interest that you use to pay for your collateral or you receive for posting collateral. And if that interest benchmark has changed from, say, Fed funds to SOFR, then it may implicate the value of the derivative. For float cross-currency swaps, however, I must add that there is a possibility, for instance, say, sterling LIBOR versus dollar LIBOR. There is a possibility of a mismatch between the legs in the sense that sterling LIBOR leg would fall back to SONIA after January 2022, whereas for dollar LIBOR, it might only fall back after the indexation effective date, which is the June 2023 deadline. So this in essence kind of like encapsulates how would this IBOR transition affects cross-currency swaps.
Great, thank you. We've got quite a lot of questions, so I'll just try and make my way through them. Somebody's asked, what is the timeline for this transition and how long is it expected to take to convert? Very much an individual question depending on your contract, but as we said for the timeline, December 31st of this year is the end of most non-US dollar LIBOR and some US dollar LIBOR tenors. And for US dollar, it's the 30th of June. How long is it expected to convert? The quicker you get started with your remediation, the better it would be for you, is our message. Can you still take up short-term SOAR loans before the cessation date? Can you still take up short-term SOAR loans before the cessation date? I think, who's happy to take this one? There's a SOAR question here. Tech Piao, what is our stance on taking short-term SOAR loans?
Sure. I believe the SES, CSF have already set out expectations that firms should not be, generating new SOAR transactions in the cash space, so for both loans and bonds. generally, and it's really encouraging the industry where possible to essentially use other benchmarks such as SORA for in the cash flow. So that messaging has and I think the expectation has already been set out. So for clients, I think it will be important to see I think the rationale obviously for such short-term products and whether it's possible obviously to do a SORA or other rates, other sing rates for, let's say, that short-term, that particular short-term facility.
Thank you, Teck Pia. There is a question from someone. Prior to the December cessation date, can market participants switch between IBOR and the RFR? I'm not sure how to. I'll interpret the question the way I see it. The answer is it implies that you want to remediate between from LIBOR to an RFR, and the short answer is yes, you can do that ahead of the cessation date, December 31st. There was another question on SIBOR. Is SIBOR undergoing a transition as well? Teck Pia, I'll just send all these Singapore-related questions your way.
Yeah, so SIBOR is undergoing transition. It's got a slightly longer timeline in terms of cessation of the 6 months. And then after that, the EU's 1 month and 3 month tenors will be ceased. So SIBOR is primarily used in the cash flow, so retail mortgages, retail lending, as well as corporate facilities. So SIBOR is ceasing towards I think the latter part, so after 2023. But the expectation is that, like I said earlier, together with SOR, SCSDS have said that firms should not offer or should not be transacting new SIBOR and SOR products after September 2021. So that's the timeline. And then essentially firms have the next few years to remediate the legacy exposures in SIBOR as well as SOR. Harmony?
No, thank you. And also, if I could just refer, there's been a few questions on SOR and SIBOR. The Association of Banks in Singapore, ABS, as well as MAS, that have a lot of information on this and it's quite well structured and laid out. So please do, and there's an FAQ document. Please do refer to that. But also, you could email us at ibor.transition@sc.com, and we can send you material as well and links to these various resources where you can understand further, particularly on SOR and SOR to SORA transition. We have a question here. Given the ISDA has launched the IBOR fallback supplement which amends the ISDA, will a client be required to execute the updated ISDA? Lillian from
I can take this. Yeah.
Sure.
I'm not really sure I understand the question, but hopefully I can clarify it through my response. So I believe the question is asking if the client has already entered into a new transaction which includes the supplement, which came into effect on 25th January 2021, just want to clarify that the new transaction or the new LIBOR transaction will have included the IBOR fallbacks from that date. If I understand the question correctly, I think you're asking if the client also needs to enter into the 2021 ISDA definitions, which is expected to be finalized but has not yet been. So in that case, when the 2021 definitions come into effect, the new transactions from that effective date will include that set of definitions. Hopefully that makes sense. Back to you, Carmody.
Yeah. Thank you, Lillian. I think if the person would like more clarity, unfortunately they've posted as an anonymous, so I can't really reach out to you afterwards. So if you have more questions on this or follow up, as I said, do email us. There is another question here around. I think we did answer that one. There is a question here from somebody around, and I think, Ryan, I'm just going to pose this to you. For existing US dollar facilities of 1 month, 3 months, 6 months, the time that extension is 30th of June, and that's correct, yes. And accordingly, the interest rate or IRS hedging of such US dollar deals is it also extended to the 30th of June? Ryan, did you get that question?
Yeah, Kamini, I would
Go
interpret
ahead.
this as like the forward spreads would come effective past the 30th of June 2020. Between
Yes.
now and June 2023, the fallback spreads will not apply. And therefore, if a client comes to us and say that we want to convert existing IBOR-based derivatives to risk-free rates, then we will convert them using the market rate, or the basis, or the RFR LIBOR basis. Between now and the pre-indexation effective date will tend to be lower than the fallback spread, simply because central banks have enacted extraordinary monetary policies. You'll be happy to follow up this question via email, if it's available as well.
Yeah, there's somebody by the name of Ramzan, so we'll contact you afterwards and follow up with you if that's okay. It's just after 6 p.m. here in Singapore, and our 1-hour session has come to an end. Thank you very much. It's been a very robust discussion, and we've had terrific questions from all of you. And I'd like to thank our panelists as well for jumping in and answering all your questions. If we've missed out on any of your questions and you really want to get some thoughts on that, please do email us. If we have your name, we will reach out to you, but a lot of you have been anonymously posting here, so do contact us. As I mentioned, you will all receive a link to a recording of today's session as well as the slides. And so again, any follow-ups, just come our way, and we will be happy to engage. If there's nothing further, we will let you continue with your day or your evening, and thank you very much for joining.